Bridget, the stock market is down, and which means it's a great time to sell. Sound confusing? We're going to tell you why that actually makes sense on this episode of Friends Talk Financial Planning. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan-Mermel. I've got a fee-only financial planning practice in Chicago, Illinois. And before we go further about talking about what and when to sell stocks, go ahead and click subscribe. It helps people find us on YouTube. Okay, John, just to be clear, we don't recommend this all the time. Stocks are down to go sell. Actually, we usually take a long-term point of view, but there are things to sell now. Yeah, it's time to sell certain things.
It's counterintuitive, right? Like you don't want to sell low. You want to sell when it's high, right? Like that's the whole thing. No, don't sell low. Hang on to things.
Right.
And so as we have these conversations, it's sort of the antithesis to what you're supposed to do, but there are some reasons for it, right? And I know that you and I both think similarly, at least a number of these things.
Right.
But one of the places that it does make sense to sell, and that title, not those stocks that are down, but when let's just say we have international stocks and the U.S. stocks, and U.S. stocks go way down. Now they're out of balance. Well, to get them back into balance, we have to sell some of these international stocks and put it over here to get them back to even, right? That sort of thought process. So it's selling really the ones that haven't gone down and buying those other ones. But it feels weird when, hey, things are kind of unsettled in the economy and the markets, and we come to folks and say, listen, we think we should sell this one and buy that one. And you go, wait a minute, when things are uncertain, why are we selling things? And it's this idea of getting things back into balance. And really what it ends up being when you sort of peel back the onion and look underneath it, it's selling the one that's done well and buying at a lower level. But it doesn't feel that way when we sit down and talk about, hey, let's sell some of the stocks in your portfolio for the purposes of rebalancing, right?
Right, absolutely. So the other thing I really agree with what you're talking about is that it's about rebalancing, right? How often do you recommend rebalancing? Because the rebalancing comes with some costs and you can kind of go crazy with it. We recommend once a year. So that's when we find that like there's the most benefit. What are your thoughts there?
Yeah, well, that's a great question. And I'll tell you, I say to people all the time, I wish there was some scientific evidence that told us exactly what the best thing to do is, because I do it. And all the research that I've seen continues to be all over the board. I've actually seen studies that say rebalancing every week produces optimal results, which of course raises a whole bunch of tax and other complications. I've also seen a study that says rebalancing every 5 years is better than doing it yearly or some shorter time frame. You kind of go like, wait a minute. And so for us, it's sort of a mixture of art and science. We do it twice a year, sort of based on systematically, but then we do take a look, and I would suspect that you maybe do too, is, when the market back in 2020 goes down, 18% in 6 weeks, we do take a look at it periodically as if you have some extreme events over the years. So there's some sort of the science to us, hey, twice a year systematically we're going to have a plan, but then there is some art where we go list. And once we get off by more than a certain percentage, we'll at least take a look at that and see if it makes some sense to do.
And we do it once a year, like a total rebalance, but then we try to set up our plan for the year. So new money's going here, because you don't necessarily want to sell a lot of stuff, realize capital gains. Like we try to avoid that. So we'll kind of set up our plan for this is where new money is going to go. And then another time we'll take a look at it is when we're looking at tax loss harvesting, which sometimes we'll do this time of year, like if there's a big market event, but then more often we look at tax loss harvesting at the end of the year. Now, and if you go tax loss harvesting, you could probably make a big argument for doing it more often than that. But for us, it's just like, we look at it strategically twice a year.
Wow. Yeah. And that to me was the other big aha moment. And like, hey, selling stocks, we do it in service of rebalancing, but also this tax loss harvesting.
Yeah.
Just to be clear on what that is when you invest a certain amount, say I put $100,000 into a mutual fund and now it's worth $90,000. If I sell that from a tax standpoint, I take a $10,000 loss and can apply it to my tax return, right? And there's some other math that goes into that, but that's the effect is sort of making some lemonade from lemons sort of thing. Market, this investment is down, but I can realize a tax benefit. But then when we do tax loss harvesting, and I think it's the same for you, is if it's a small company, a small cap fund, we sell this one, we've got the tax loss. That's the other thing. It feels weird. Wait a minute, this has gone down. Now you're getting out. Are you changing your philosophy? We're not going, are you
Right.
going to cash?
Yeah.
Like, no, we're going to sell this small company fund and buy that small company fund, something that has an exposure to the same type of funds, but it's a different investment. And that way we get a chance to realize that tax loss from the tax return, but yet we're not changing the mixture of stocks and bonds. We're not getting out. It's not a matter of we don't like this fund or we don't think this category makes sense.
Right.
It's a matter of saying, hey, can we rejigger things within that category to generate some tax benefit?
Mhm. And sometimes similarly, if clients come in and they've got individual stocks, those are a lot more volatile, but we don't want to sell them because it's not that big of a position. And in other words, they don't have that much of it. And, they would have to realize capital gains then. And it's like sort of a neutral in their portfolio as far as we're concerned. Then if those goes down, we'll sell that and then buy what we would usually buy.
Yeah. Yeah, well, that's the other great thing. I appreciate that one too. And we've got some similar positions where it's like, we don't hate this fund perhaps or an individual stock, but we don't love it either. But because of the tax hit, we don't want to. And
Yeah.
again, if it's at 100,000, now it goes down, and our tax gain is lower. You go, oh,
Right.
maybe it's more palatable to realize that tax gain, in making some moves on that, right? And that
Right.
usually happens for us when we've got new clients that come in and they've got a portfolio that looks like, what it looks like, and you go, hey, in the IRA accounts and the Roth IRA, we can make moves there, no
Right.
big deal because there's no tax
Mhm.
consequences. But golly, in the brokerage account, we don't want to just sell everything. And there's a lot of folks in our world that do just take everything, sell it, and put it into their portfolio. And then there's I mean, we've had clients that have had six-figure capital gains because, and I'm not saying that it's necessarily wrong, but not intentional, right? They didn't know this
They
was
didn't
a
know.
plan.
Right.
There are cases where certainly it makes sense to do that, but you have to be intentional and understand where the taxes come from on that, right?
That kind of what I would consider a boneheaded move by advisors is one of the reasons why I got in the industry. Because when I had my tax practice, I'd see that kind of stuff and I'd be like, look at how much tax these people are paying on it. What are you doing? Just because you want to have your pet funds, you're realizing all these capital gains. I just disagree with that.
Yeah.
Yeah.
Yeah. And to me, it's just when there's no intentionality to it, right?
Right.
If you look at it and you go, listen, I think this is the best thing to do. Here's the tax consequences, but
Right.
we're
Exactly.
gonna do it anyway. You go like, okay, great, we can make a decision. But when you have a tax surprise come the spring because you didn't know what you were doing, you didn't realize, understand what was going on, right? Like that's where the problem comes in.
We have a client who inherited a bunch of NVIDIA. Like
Oh,
the person who passed away was like an early adapter and invested a lot in NVIDIA. So the stock, even since they inherited it, has like skyrocketed. And so in that situation, that's a situation where there's enough of it so that we want to sell it anyway. It's a concentrated position. We're like, we don't care we're not selling it because taxes or even thinking about taxes. We're selling it because this is too concentrated of a position. They've got too much of this.
yeah,
So I think it's important to realize that you don't really want to have taxes driving all your investment decisions. Like it's
that's right.
generally because it's easy. Like, so say the taxes are 25% on that, and I'm just throwing a number out there. It's easy for the stock market to go down on an individual stock for 25% in one day. That
Right.
happens all the time. So it's important to balance those things. Like with when you have too much of it, or we call it in the industry jargon, please, concentrated positions, uh, that's a different situation than when, this is what we think of as a neutral thing that maybe we'd like to get rid of.
We talk all the time about the allocation policy, where your
Mhm.
money is invested is the first most important thing.
Right.
And then we try to be as tax efficient as we can within that framework for the reasons you just described. You just reminded me of some situations over time where we have some of those really concentrated, right? A lot of money in one stock relative to the rest of a portfolio. We've done some things, people are familiar with dollar cost averaging by
Hmm.
buying the same amount of a stock or mutual fund every month. We've done it on the reverse basis, saying, listen, let's dollar cost average out, because what if
Oh,
the
yeah.
stock keeps on going up or different things? Go, listen, let's just set a plan, and every month we'll take 10% of that and sell it. And then if it goes up, we're going to make some more money. And if it goes down, we're cashing out earlier. And that reverse dollar cost averaging and not paying attention to what's going on with the stock or what their earnings are or any of those things, right? Having a plan can be a really effective way of unwinding some of those positions depending on the circumstances.
Right. And sometimes it's almost like you have to close your eyes and just do it,
That's
because
right.
it's just
That's
like
right.
jumping into a pool or something. Like, all right, I'm closing my eyes. See that it's safe. I'm going to close my eyes and do my plan.
I think that's a great place to wrap up again. As you're talking about, hey, the markets are down in the US stocks anyway, but there is reasons to sell for rebalancing, right?
Right.
For eliminating positions, for tax loss harvesting, not for getting out and putting it into cash and changing your philosophy, but for making your plan more efficient. With that, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan Ramel. I've got a family financial planning practice in Chicago, Illinois. John and I are both taking clients, but we're also members of an alliance of advisors called the Alliance of Comprehensive Planners. And if you want to find an advisor who thinks similarly to us, you can check out acplanners.org.
And don't forget, hit that subscribe button.